I'm with Dave Zellner, the CIO at Wespath. Dave, great to see you at these strange times, times where people are saying the talk is that ESG is at a pivotal moment, at a tipping point. Is it? And what does it mean?
Well, hello, Daniel, and thanks for the opportunity for allowing me to present Wespath's views to your audience. Certainly for a majority of the developed world outside of the US, it seems to me that we've long passed the tipping point. From what I read and hear, ESG seems to be embedded not only in the DNA of asset owners, but asset managers and companies as well. But the US is obviously a different story. And while ESG is getting a lot of attention, I think that many asset owners and certainly asset managers remain what I think is guilty of ESG washing, and as they try to appease a growing universe of their stakeholders that are expecting ESG integration. Now, I do believe that the asset manager community appears to show a greater commitment to ESG integration, at least compared to asset owners. But however, aside from some leading funds, public funds in California and elsewhere, the sense I get from most of my CIO peers is that they still aren't convinced that considering ESG factors in their investment process will enhance returns, and they require more proof.
So we're in a short-term, hopefully a relatively short-term crisis, but how do you reconcile that with long-term investment thinking?
Well, first, I'm not sure that I would agree that the market can only see short term. Many different types of players in the market, and I characterize them in four different buckets. The first is what I would describe as long-term disciplined investors with essentially an infinite time horizon. These are typically asset owners representing benefit plans or endowed assets. Second, you've got retail investors, and these are private persons that choose to make their own investment decisions. Many apply a disciplined approach to their investing, but there are many that are chasing returns and just don't have the courage to ride through periods of uncertainty, similar to what we are experiencing today. The third are what I would call benchmark aware investors, and those are investors that are subject to business risk associated with meaningful or extended underperformance compared to their benchmarks. And these are typically asset managers or financial advisors working on behalf of asset owners or individual clients. And then the fourth I would characterize as opportunistic market timers. These are typically asset managers and often hedge funds and algorithmic traders. They're agnostic to macroeconomic or any company-specific fundamentals, particularly ESG fundamentals. So short of a very onerous tax on financial transactions, I don't think we'll ever be able to rectify the short-term actions of the retail investors who lack courage and the opportunistic market timers. They're always going to be with us. I think that probably the most meaningful shift to long-term thinking belongs on the shoulder of us asset owners. Specifically, those who claim to be long-term need to demonstrate greater patience with their asset managers. If not, we'll never overcome the business realities that asset managers must always consider when making investment decisions, which I believe inherently conflicts with taking a long-term view. And also, if you're an asset owner and if you've engaged an asset manager that factors momentum into their investment process, don't tell me you're a long-term investor.
So in this context, what's the message to clients and beneficiaries at this moment?
Well, we've been communicating with our clients and other stakeholders and reinforcing that we're disciplined long-term investors and we're not market timers. We're very patient with our asset managers. We highly prefer low turnover strategies among our equity managers, which have proven to be our best performing strategy. In addition, we've also told our clients that we believe in human resilience and that we're going to rebound stronger from the current crisis. We'll continue to engage the business community, the investment community, and public policymakers to promote achievement of a sustainable economy, which requires social cohesion, prosperity for all, and environmental health. We believe a sustainable global economy ensures the development of healthy financial markets and resilient companies, providing greater security for our participants and institutional investors to help them attain their financial goals.
So looking forward from your perspective, what does the asset management community industry look like after the crisis?
I really don't think, Daniel, that there's going to be much difference regarding the investment approach and time horizon of the asset manager community because of COVID, unless, of course, as I indicated earlier, asset owners change their behavior. I'm not yet convinced that COVID will really change the way investors integrate ESG decision in their process. With that said, I do think that the pandemic has raised awareness of the importance of the S in ESG. Notable is the significant investor attention given to the investor statement on coronavirus response initiated in the US by Domini ICCR and the New York State Public Fund. The big difference for the asset management industry, I think, will be how members of the community work and interact with each other. I think that work from home and video conferencing will now significantly replace pre-COVID in-person activities, which will ultimately be better for the world's environment and worker productivity. I really believe that a decrease in stress resulting from commuting and travel will ultimately lead to better investment decisions.
Dave, it's been great talking to you. Thank you so much for your time and insight.
You're welcome, Daniel. Thank you.